In this week's video, we'll review the latest charts and data to help us answer the question, how far will stocks fall? We'll be moving quickly, so feel free to use the pause button on your video player. Somewhat of a mixed bag on Friday, August 1st from a longer-term perspective. First, the bad news. The monthly labor report came in worse than expected at 73,000 jobs. Expectations around 100,000 jobs. And maybe more importantly, the prior 2 months were revised in a negative manner, in a fairly significant negative manner, casting some doubt on the strength of the economy and the labor market. The good news, the Fed, as of Thursday's close, was for the most part out of the equation for the September meeting. There was a 38% probability, based on positioning in the bond market, that the Fed would cut in September. That number jumped significantly after the weak labor report, all the way to 85% during the session. At the end of the day, it was pushing 90%. We'll begin the video with the NASDAQ and the S&P 500 and then provide some historical perspective on volatility, cover some recent signals, and try to understand how concerned market participants are currently about inflation and how concerned they are about an economic recession. You may remember in a recent video, using this daily chart of the NASDAQ composite, we said we had an overshoot here earlier in the year, and we all know markets like to overshoot. And ultimately, that overshoot turned out to be a short stay, which tends to lean bullish. And we recaptured the upward sloping trend line, if you extend this chart back, tied to the current uptrend. Thus, this region in here, based on the upward sloping trend line, represents an area of possible support. What once acted as resistance here may now act as support. And this long volume by price bar here also tells us that it's reasonable and prudent to see how the NASDAQ acts in this area if it decides to backtrack that far. Keeping in mind, just like this region in here, overshoots are common. This is admittedly a noisy chart, but as we've said in the past, using numerous reference points, it helps us determine where trends and volume tend to cluster. So once again, we're looking at a daily chart of the NASDAQ as of the close on Friday, August 1st. So we've got the February high in here in this region of prior resistance. It's where this dotted line is. That's also where the upward sloping 50-day moving average comes in. It's the dotted line here in blue. The thin lines are the more recent anchored volume weighted average price lines. And you can see the thicker lines that carry more weight, they're longer term lines, are intersecting with the moving averages. So once again, we have the 50-day moving average dotted in blue, the 200-day moving average dotted in red, the 100-day moving average dotted in green. And you can see we've got this tight cluster in this area here. Hypothetically, if the NASDAQ were to backtrack into this box here from the recent closing high in this region up here, that would represent a correction of approximately 11.3%. And that falls into the 100% normal and to be expected category, not a prediction in any shape, form, or fashion. The closing drawdown hypothetically from the recent high, if we bounced or held at the rising 50-day moving average, would be a little over 5%. And if we came back and filled this gap here from June of this year, from this recent closing high up here, that would represent a normal pullback of about 6.5%. Moral of the story, we have numerous reference points that enable us to be patient in the short to intermediate term. All of these regions represent areas of possible support, meaning we'll learn something either way based on these reference points. Concerns would increase if the NASDAQ moves into this area here. The longer it stays below the black box, the more concerning it would become. But notice the cluster of lines in here tends to be turning back up and upward sloping. And we really don't have anything that says the uptrend, the shorter term uptrend off of the April low here when the tariff news became less bad, is in jeopardy. And that would be true if we backtrack all the way to the black box. And as of Friday's close, it's probably fair to say before this is over, the odds probably favor additional downside. But relative to our time frame, nothing has happened yet that's overly concerning. Very similar concepts when we look at a daily chart of the S&P 500 index. What once acted as resistance in this region here may now act as support. If the market backtracks that far, we've also got 3 relatively large volume by price bars in this region here, and we have the cluster of the moving averages down here. Moving averages on your screen, trends converging range from the 20-day moving average in blue all the way out to the 250-day moving average in black. Now we're adding in the anchored volume weighted average price lines. All of these lines are anchored to reasonable levels, either gaps, for the most part, highs and lows. We've got the upward sloping trend line here. That's where we came back to during Friday's session. We still have this region back here that acted as prior resistance in February of 2025, and the anchored volume weighted average price line here tied to this high, hypothetically based on this closing high up here. If we backtracked to this anchored volume weighted average price line in here, that would represent a closing correction of 8.75%. Similar to the chart of the NASDAQ, we have an upward sloping 50-day moving average dotted in blue, a trying to turn up red dotted 200-day moving average, and a now upward sloping green 100-day moving average just below the 200-day. Hypothetically, from the closing high up here, which means we've already taken on some of this pain. If we backtracked to the 50-day as of Friday's close, that would be a pullback of approximately 3.85%. If we went back to the dotted red 200-day moving average, roughly 7.5%. If we went back to the dotted green 100-day moving average, a little bit more than 8%. And if we look at that anchored volume weighted average price line here, if we zoom out, tied to the recent low that was made in early April on Friday, it was at 58.89, just about to intersect the 200-day moving average, the dotted line in red here. You can see the anchored volume weighted average price line tied to this high here and this low here recently intersected. When that happened here, this is a similar fractal in this region here. After we made the new high here, we did experience some consolidation and a pullback of approximately 2 to 3%. We're not making any assumptions about how far the market is going to backtrack. We'll see how it unfolds next week. It's easy to talk about volatility being 100% normal and to be expected when the S&P 500 and NASDAQ are printing new all-time highs almost every day. But it's good to keep in mind, in a typical year going back to 1928 using this graphic from Carson, the S&P 500 experiences a 3% dip approximately 7 times per year. Can you imagine if you overreacted to every 3% pullback in the S&P 500 and significantly raised cash 7 times a year? You would turn into an overtrading machine, and it would most likely significantly harm your long-term returns. Even 5% pullbacks in a typical year occur more than 3 times. And a 10% correction, not unusual. Happens about once a year. And if you look at this word dip and this word correction and this word correction, by definition, in every one of these historical cases here, the market went on to print a new high. That's what corrections do. The market pulls back, and eventually it goes on and makes a higher high. So historically, again, using data going back to 1928, not unusual at all for the stock market to fall 3%, not unusual for it to pull back 5%, and not highly unusual to pull back 10%. That's why reference points can be so valuable. Since we know a 3.75% pullback, a 5.71% pullback, a 7.66% pullback, or a 9.23% pullback would be included here, here, or here, the reference points that we have, they don't predict anything. They help us discern between volatility to ignore and volatility to respect. It's easier to remain patient as long as the S&P 500 remains above 5,800. And relative to the closing high up here, if we pull back to 5,800, the bottom of this tight cluster of moving averages ranging between the 20-day and the 250-day, that would represent a closing correction of 9.23%, which is not particularly alarming from a historical perspective. And since we haven't seen anything even remotely close to evidence that would put the secular bull market in doubt, it's also good to know historically. In the secular bull markets between 1950 and 1968 and 1982 and 1999, drawdowns between 9 and 11%, fairly common. Thus, when the volatility starts, we want to remember that our goal is to navigate between a point A and a point B that could be several years down the road, and we don't want to let fear of normal corrections and pullbacks be the enemy of achieving that goal. At the same time, we don't want to make any assumptions about how things unfold in the coming days and weeks. That's why we use a weight of the evidence approach to once again try to discern between volatility to ignore within the context of existing uptrend and volatility to respect. We said in these cases here that by definition, eventually the stock market went on to print a higher high. Do we have any evidence in hand that tells us we should try to be patient relative to that topic? The answer is yes. Recent signal from our buddy Dean. Here's his Twitter handle, @DeanChristians. When something similar happened, similar to something that just happened in 2025, the S&P 500 rallied 93% of the time. Median return 1 year later, 11.3%. Tech did even better, 14.2%. Consumer discretionary, 16.7%. Median gain 1 year later, and communication services, XLC in the ETF world, tacked on an additional 14.7% in the historical cases, simply telling us to keep an open mind about better than expected long-term outcomes, while maintaining realistic expectations about how markets operate in the real world. Limited sample size here, you can pause your video player. The S&P 500 has closed at a record high 10 times in July. Now, we all know that can't continue. And common sense tells us at some point we're going to have some type of give back or correction. In similar cases historically, average gain in the NASDAQ a year later was 20.9%. The median gain was 20.5%. Nothing to write home about 1 month later, and even 3 months later. Median gain 0.6%. 4 months later, 100% of the historical cases, limited sample size. The average gain was 5%, the median gain was 3.4%. Something else that you may have noticed when you look at this data set and the chart on your screen. Following this signal here, the market did extremely well looking out several years. From this signal here, it did extraordinarily well for over 2 years. And relative to this signal here, from a long-term perspective, things have gone extraordinarily well for over 10 years. After the 1997 signal, admittedly a rare event and a bubble, the NASDAQ gained an additional 216%. Over the next 5 years, from this signal here in 2013, the NASDAQ gained an additional 111%. Anything else that tells us it's reasonable that the S&P 500 could go on to print a new all-time high after pulling back in a normal manner? The answer is yes. We're in rare territory relative to the number of S&P 500 sectors above their 200-day moving average. When you're in this territory, the annualized return for the S&P 500 is an impressive 18.2%. When you're not there, 8% and 9.8%. And looking at all of the historical cases, 6 months later, the market was higher every time. Average gain 10.1%, the median gain 9.5%. Further down in Dean's report, sector performance after 10 out of 11 S&P 500 sectors closed above their 200-day moving average. Median return in the tech sector a year later, an additional gain of 19.6%. This is a chart of value stocks IVE relative to XLK. This is a chart that we used earlier in the year to help assess the probability of the market flipping in early April from risk off to risk on. If really bad things are going to happen, most likely we're going to go down one of two roads. Either we're going to repeat the scenario where the market is concerned about rising inflation and we actually see a significant increase in inflation, similar to what we saw in January of 2022 and during the bear market in 2022. And you can see when market participants started to become very concerned about inflation in January of 2022, this ratio shot up like a rocket. That's not really what we have as of the close on Friday, August 1st. If we were to experience an additional drawdown in the markets, which would not be surprising in any shape, form, or fashion, it's possible that this region in here for this ratio would act as resistance, and more likely this region in here. If we were to shoot through those AWAP lines similar to what we did here earlier in 2025, so if we break through this, concerns would increase. Similar situation. If the tariffs are eventually going to cause inflation, we would most likely expect to see XLE outperform XLK. And you can see even before the S&P 500 peaked on January 3rd of 2022 here, the ratio of XLE to XLK was rising. We even had something similar over here when we had the tariff drawdown in the S&P earlier in the year. We don't have anything like that yet as of the close on August 1st. If the look of the ratio starts to morph into something more like this or more like this, concerns would increase. So we have one scenario where really bad things could happen, and that's a significant increase in inflation in the actual data, similar to 2022. And the other end of the spectrum would be more of a traditional bear market and recession. That tends to be a deflationary event. If you go back and look at the financial crisis and the performance of asset classes or those who lived through it, remember this, in that type of deflationary event, bonds significantly outperform stocks, and that's exactly what happened between October of 2007 and March of 2009. This look here, this little mini spike, is telling us the odds probably favor additional downside here. We'll learn more if this ratio gets into this region here. If it slices through it, concerns would increase. If this acts as resistance, and it happens simultaneously to the S&P 500 backtracking into this region here and holding near support, then we would learn something about probabilities associated with the end of the pullback. Let's cover an important topic about managing portfolios. And let's talk in hypotheticals. It's not particularly difficult in here to determine in the short to intermediate term the probability of the market backtracking is most likely higher than the probability of the market rising. But it's extremely important to keep in mind, our goal is not to avoid all pullbacks and avoid all pain. Our goal is to make money. And our goal is to stay with the long-term trend. So let's say hypothetically, yesterday on Thursday, when we had this candle here, the daily candle, you said I'm taking 50% of my portfolio off the table. That decision in and of itself is not particularly hard. But after you do that, that's where it gets hard. Once you do that, you've forced yourself into another decision. When do I redeploy that capital? Do I redeploy it on the first bounce? Do I redeploy it when we fall approximately 6%, 8%, 10%? And what happens if the pullback lasts 6 months and there are sharp counter trend rallies? Typically what's going to happen is you're most likely going to overtrade your account. And if our confidence level is still relatively high, that any pullback will be followed by a higher high, and if our objective is to navigate between a point A and a point B that could be several years down the road, it's most likely much easier to make the decision that we're willing to ride out 100% normal and to be expected volatility. We're willing to take that short-term pain for the longer-term performance. The primary objective is to see the balances of our accounts grow over time. Not over the next 3 days, not over the next 3 weeks, not even over the next 3 months. We're concerned about what our balances will be in several years. Back to concerns related to inflation. For the most part, since the market made a stand here in 2022, things have been fairly tame. We would learn something if the 30-year Treasury moves into this area here. The longer below, the more relevant it would become. Right here earlier in 2025, the AWOP line for the ratio of consumer staples relative to the S&P 500 was breached. This is a risk-off region in here when the market was extremely volatile earlier this year and concerned about tariffs. Thus, we'll learn something if and when the ratio gets back to this region in here and this region in here. If you're a stock market bull and this turns out to be a relatively shallow pullback, you would like to see these regions act as resistance, or you would like to see the ratio remain below these lines. If you're a stock market bear, you want to see something more like this. Thus far, we don't have anything that looks particularly alarming. Similar situation here. This is IEF, 7 to 10 year treasuries relative to SPY. This is our reference point here. This would be the bearish look earlier in 2025 that the bulls would like to avoid. What the bulls want to see is this ratio staying below these lines or this region acting as resistance. This move here says be open to more downside, but also be aware of this region in here acting as potential resistance. So as things unfold next week and in the coming weeks, keep in mind things have gone very, very well since early April. There's no free lunch in the stock market. We know volatility is 100% normal and to be expected. And we know we have numerous reference points relatively close by, and numerous reference points that fall into the 100% normal and to be expected pullback category. As always, the commentary in this week's video is based on the charts and data in front of us. If the charts and data change in a material manner in the coming days and weeks, the only way all of this can be helpful, and the only way we can read a transition properly when the market shifts, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.